Welcome back to the channel. Tom Mason with Coldwell Banker Realty. Today I'm with Lynn, Gallett, Vice President of Mortgage Lending with Guaranteed Rate Affinity. These people back here. We're going to talk about a different kind of lending that will help you get into a house a little bit faster. So for coming, Lynn.
You're very welcome. Glad to be here.
One thing I wanted to talk to you about was Fast Track. Can you tell me what the Fast Track program is with Guaranteed Rate?
Our Fast Track program is basically a way, if a buyer is pretty plain vanilla, like I like to say, with a W-2 income, retirement income, fairly easy underwrite, where we can have the buyer clear to close 24 hours from the time we have all the documents needed. The file goes to one person and we're in contact with anything else needed, and our underwriter will get the file clear to close by the next day.
So can someone who needs a mortgage, can they submit that to you online, all the documents that they need through your website?
Yes, we can either upload the documents, which would be W-2s, pay stubs, whatever we might need, or we also have automated systems that will verify employment, as well as online banking programs that will verify the accounts straight from the buyer's bank.
So this is currently used for conventional loans only, but I heard you're working on FHA and VA.
They're always changing this program to see what will work best.
Great. Another thing I wanted to talk to you about was the 3-2-1 buy down or the 2-1 buy down. There's a couple different ways that people can finance and get a lower rate initially. But can you tell me about the qualification for like a 3-2-1 buy down?
Any temporary buy down program we use, which would be a 3-2-1 buy down or a 2-1 buy down, does require that the buyer qualify at the higher rate, at the rate that the loan will be locked at. So this is not any type of adjustable rate mortgage. It's a 30-year fixed rate mortgage, but we have the availability of using seller credit to buy a little bit lower interest rate for the buyer for a 2 or 3 year period.
So the 3 represents a drop in 3% on the loan. So if it's 6.5% today, for the first year, they're only paying 3.5%. Correct? So let's say that interest rates drop in the second year. What's the benefit to having the 3-2-1 buy down as far as refinancing?
So the money that is paid by the seller goes into I like to call it a separate escrow account that is managed by GRA. And we pay the difference each month of the payment. And then if the buyer is eligible to refinance, if the rates drop, that money belongs to them. So that money can be used to pay for any closing costs with the refinance, any refinance fees. It can be used to reduce the principal if there's any money left, or if the buyer happens to decide to sell, it will reduce the principal of the house when they go to sell it. So it's their money. All
right, so the first year, in our example, they're paying 3.5%. Let's say second year interest rates drop to 4%, they want to refinance. They can take out the remainder of that money that was set aside in the 3-2-1 and actually pay for their own refinance.
Correct.
So it saves them a lot of money in the end as well. Are there any other benefits to 3-2-1 besides the drop in interest rates?
Well, I think it helps a first-time buyer get more comfortable with that payment, and knowing, as long as they know that at the end of the 3 years that they will be paying a higher rate if they can't refinance, it helps them get more comfortable with the payment if they've never owned a home before. Also, what a lot of my higher end buyers are saying is that, well, why not save that money down now, as we discussed a little earlier, save the money now and worry about the lower interest rate later and still have that money in the bank.
Right. So someone who's financing a mortgage, they have to qualify at the 6.5% initially anyway, but they're only going to pay 3.5%, which means they should have a little bit left over in their paycheck every month to set aside, which would be good for, let's say interest rates don't drop. At least if they set that money aside, then they can do a permanent buy down later with the money that they're saving, putting aside, because they're making more. They had to qualify at 6.5.
Correct.
They're only paying 3.5, so they should have something to save. As long as they're good savers, then they put themselves in a great position to refinance permanently at a lower rate.
Correct. And it helps a buyer that's maybe never made a mortgage payment get used to having to make that payment. It keeps them from having to pay higher apartment rents if they're thinking about renting, because we all know what those are right now.
Right. So we know that the home builders have really stopped pulling permits to build single-family residences, and they're really focused on multifamily housing now. In fact, 8 out of 9 permits that the new home builders are pulling are to build apartments, turning people into renters. When they rent, they're paying 100% interest rate.
Absolutely.
I mean, that money is gone. And if you stay there for 10 years and you're paying rent for 10 years, you're never going to see that money again.
Right.
But if you get into a house, we know that over time, even if we have a drop in prices a little bit currently, I mean, we're pretty flat from last year on prices now. Instead of shooting up like they were, we're pretty flat from last year on the price of homes. We know eventually that's going to go back up again, price of homes. Particularly when you have people who have been stuck renting for so long and they really want to get out of that situation from an apartment or even renting someone else's house to build their own equity, build their own wealth. And that's an important aspect, I think, because your personal wealth and the personal wealth of most Americans is based on home ownership.
Absolutely.
And you calculate your personal wealth by taking what you own, the amount that you own, savings, let's say you pay off a house, and you subtract your debt. So if you own a $400,000 or $500,000 house and you've paid it off over time, your personal wealth has gone to $400,000 or $500,000. And then you subtract whatever your bills are. So, but if you're renting all the time, that money's just gone, and you're still paying your debts. So you're in a negative personal wealth situation without owning some kind of big property or something of value. Right?
Well, and Tom, in my mind, it goes even above the financial wealth that we're trying to create. To me, there's pride of ownership in a home that you call your own, whether it's 1,000 square foot condo that you get to walk into every day that's yours, that you can paint the walls pink and purple stripes if you want.
I like pink and purple stripes.
And that may appeal to you, but it's your home to make your own. Mm-hmm. And when you rent, there's always that little bit of thought in your mind that, well, why do I really care if the paint's perfect? Or why do I really care if the yard is going to get mowed this week or whatever? There's just not that pride of ownership that comes with making someone else rich.
Right. That's a really good point. When I taught criminal justice at several different universities, one thing I noted, or one thing I used to teach my students, is places where you have a heavy concentration of renters, they're not bought into that community. So they're not really going to contribute back to that community. It's not something that they plan on staying at. But if you get into a neighborhood, and even in this internet era where we all live in our own little environment inside our homes, what goes on in your neighborhood you're more concerned about when you own than if you're renting. Because you think that you're transitory, you're not going to stay there anyway.
Sure.
So from a criminal justice perspective, which is what I bring to everything I do in real estate, I always check crime rates. When my buyers want to buy somewhere, I'm always sending them to LexisNexis Community Crime Map. Check that out. I check the schools, make sure those are good, because the pride of ownership is going to translate into what happens in the community as well.
Well, and for me, when I sat in my home office and I see people walking up and down my street, and they're stopping and actually looking at my roses that are blooming on the road and admiring them, that gives me a real sense of community in seeing the families. We have a family next door to us that has a bunch of little kids. They call us by first name. The sense of community you build by being in your own home, as opposed to, like you said, renting, it's just not the same feeling in my mind.
I absolutely agree. So, you and I both follow Barry Habib on his website. Do we have an idea of where we think interest rates may be going in the future?
Well, Barry Habib feels like that by mid next month, we're going to see some interest rate drop. And while I listen to
that's
a
May,
lot,
May 2022.
Yeah, May 10th, May 15th. While he follows all the stats, I approach it a little differently in terms of when I'm trying to talk with buyers, because if we try to wait for the perfect interest rate, then what are we missing out in the perfect house?
Hmm.
And as we talked about, even with the buy down or where interest rates are, when's a perfect time to buy a house? When you really want a house to live in.
Well, there's a joke in real estate. What's the best time to buy a house? 5 years ago.
Well, if you look, yes.
Yeah.
So, but again, it goes back to creating a family, creating a new retirement life for you. And will interest rates change next month? Probably. Are they going to go up or down? Well, we think they're going to go down, but I don't have a crystal ball.
Right.
And so we got to go with what we know today. And we think interest rates are trending downward.
Even if they don't, one thing I've noticed in the MLS for Phoenix is there are fewer sellers out there now. Because the price of homes have gone down, there are sellers that are saying, well, I'm just going to wait until prices go back up, and I'm also going to wait till interest rates go down, because if I sell my house, where am I going to go? Well, if they've built a lot of equity, the people who build a lot of equity aren't going to have to finance a lot anyway, right? But the people who do, let's say they made $100,000 on a $500,000 house, that really won't pay down enough to lower their
payments.
payment,
right.
Yeah, because they were paying 3% when they bought the house. Now they're going to be paying 6-7%, between 6 and 7 right now. So we've seen the opportunity for buyers going away because sellers are dropping out of the market.
Sure.
So if you want to get that opportunity to find that perfect house, now is really the time to go out and look, and then you can talk with me and Lynn to try to find that right lending situation for you to make sure that you are comfortable in the payments that you have to make. And that's what we look at. We don't look at what the total amount is. We look at how much you have to pay every month,
right,
based on your debt. So your debt to income ratio. And if you fit in there and we can get you into that house, and if we can buy down that rate initially and get you a temporary buy down, we know that long term you're going to be in a much better position than you are now.
Absolutely. Yep. Pride of ownership.
All right. Well, thanks, Lynn. Thanks for stopping
Tom.
by.
Great interview. Thank you.
Thanks.